Narendra Jain, Empowering Excellence. Friends, today's Wednesday study circle, we have arranged a very important topic and very interesting topic too. Reimbursement under implications under Income Tax Act, international taxation and transfer pricing. To impart knowledge on this session, we have an eminent chartered accountant, advocate Narendra Jain is with us. He's going to explain in detail. Even a small topic, reimbursement, requires a much more detailed session. That is what we requested. He's going to enlighten us all the nitty-gritty of reimbursement and explain it in detail. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Narendra Jain. Hearty welcome, sir. Friends, you are the reason for this program. We are continuously doing number of programs for the benefit of our members. Many are the new areas of practice. International taxation is one such important and many more needs to understand, learn and apply in practice. The international business is growing as a happening city, Bangalore, the most important city in the point of in international transactions or international trade and imports and exports. In that regard, we thought it appropriate to have today's Wednesday study circle also on international taxation. In addition to that, tomorrow, next 3 days, tomorrow to Saturday, 2 to 4th September, Thursday to Saturday, we have every day 3-hour session on international taxation or transfer pricing in detail. Transfer pricing in detail from tomorrow to Saturday, Thursday to Saturday, every day 4 to 7 p.m., 3 hours learning. Eminent speakers are going to impart their knowledge to all of us. I request all the members of Bangalore branch, those who are interested in international taxation, transfer pricing in particular, register for that program. We are going to have a very interesting sessions from all the eminent speakers. That is from tomorrow onwards. I request all of you to register. Please visit bangalore.icai.org. And another one important or very interesting topic is private trust. Private trust in continuation of our succession planning workshop. So we are conducting 2-day session, 6 hours of learning on private trust. Private trust is taking an important role in succession planning. That is the reason we wanted to have a very detailed session of private trust from eminent speakers from Mumbai. So I request all the members to look into that and register for that program. Very interesting private trust from 9th September to 11th September, 9th and 11th, 2 days, 6 hours learning. And many other programs also lined in for the month of September. I request all of you to visit bangalore.icai.org so that you can know, understand and register for all the important learning sessions. With that note, once again, hearty welcome to each one of you. Over to Divya.
Thank you, Chairman. A very pleasant good evening to all the participants and to our speakers of today's program. We have with us CA Narendra Jain to present on today's topic. To give a brief introduction about him, by qualification is BCom FCA, Company Secretary LLB. He has secured All India 5th rank in CS Inter. He has been awarded DL Majumdar's silver medal for securing highest mark in Advanced Company Law and Practice in CS Final. He has also been awarded Taxman's Prize Award for securing highest marks in direct and indirect taxation law and practice in CS Final. Also awarded Mrs. Pankajan Rengachari SIRC Prize Award for securing highest marks in advanced company law and practice in CS Final. He is presently practicing as advocate, heading NNMS Legal Chambers, Bangalore. He is also faculty for CA Final students at CAPS on direct taxes, international taxation and transfer pricing. With this very brief introduction, I wholeheartedly welcome you for today's program, sir. Hearty welcome, sir. Over to you, sir.
Thank you, head teacher, and thank you, Divya, for kind introduction. I'm audible? It's clear?
Yes, you are audible. Please go ahead.
I'll also share the presentation.
Yes, please.
So I hope presentation is visible.
Yeah, it is visible. It is clear.
Yes. So I would like to start by thanking Bangalore branch for giving me this opportunity again for sharing my thoughts on this interesting topic of reimbursement. Good evening, friends and seniors in professionals. Now, the topic that I plan to cover today, the reimbursements. As we all know, reimbursements are part of our day-to-day business practices. Every business will have some sort of transactions in reimbursement. Even we as chartered accountants or lawyers or other professionals on a regular basis have transactions of reimbursement. And apart from reimbursement, there are related topic of cost sharing, cost contribution arrangement, which multinational organizations enter into. In a business setup, reimbursements are very common. So we may incur some cost on behalf of the client, and then the client may reimburse it. It could be statutory dues, it could be some expenses that the particular service requires, or in a particular circumstances, we incur it on behalf of clients. So what are the issues? If you see reimbursements as such, one incurs 100 rupees and gets back 100 rupees. So that really do not give rise to income from the person who is spending, for the person who is spending. It might be income for the other person who is on who, and it might be expense for the person on whose behalf it has been incurred. But for the person who's in between, who is intermediary sort of a person, who is sort of accommodating or assisting the two parties, for him, there is really no income in that reimbursement. Despite that, it has implications under every law. It has implication under Income Tax Act. It has implications under GST. It has implication under international taxation. It has implication under transfer pricing. Second thing is the documentation for reimbursement. That is also becomes very critical to demonstrate that it is really reimbursement. In GST, they have specific provisions. So I'm not an expert in GST, but what I understand that if there is a expense which you incurred as a pure agent, then the GST may not be applicable, and on all other cases, the GST may be applicable. So some sort of a clarity has been tried to be brought into the law there. But in income tax, no doubt one will have to satisfy those conditions of pure agent. I believe there are 4 conditions which need to be satisfied. But when it comes to income tax, we have too many issues that arise because of reimbursement. Multiple issues arise because of reimbursement under each of these segments. One major issue that across will arise is one is the TDS issues, whether when I make a payment, whether it should be TDS. And in the transfer pricing, the issue gets further enhanced because even if I receive a reimbursement, I need to demonstrate its arm's length price. So transfer pricing will approach both reimbursement paid and reimbursement received. Whereas in international taxation, it could only be from the payer's perspective, it could only be a situation where it is an issue of deciding whether TDS is applicable or not and other connected issues. So I thought it fit that this could be a topic of a detailed discussion. Instead of just being a passing remarks as a part of other conferences or seminar, it could be a situation where we can understand this in a detail. So I have done this presentation. The flow of the presentation is that first we'll try to understand what is reimbursement, what are different kinds of reimbursement, what are certain essential features of reimbursement. And once we have this basic understanding, what are for each different kind of reimbursement, what are the implications under all the laws? under the income tax, under the transfer pricing, under the international taxation. No doubt all are part of same law, but under all the heads, what are the implications? What is the meaning of reimbursement? As we all know, the Act does not define reimbursement. For the definition of reimbursement, naturally we'll have to understand it in its general sense. And we can make useful reference to dictionaries, Black Law Dictionary, P. Ramnath Iyer's Law Lexicon. So it says repayment or indemnification. And Ramnath Iyer gives more detailed analysis of it. And it says in ordinary parlance, reimbursements repayment of what has been spent. To reimburse is to repay what is expended. So if someone has expended 100 rupees, you repay them that 100 rupees, then it is reimbursement. As we go further, we will see that whether the markup can be added. There are cases where markup is added on reimbursement for administrative support or sort of this. But then can you call that as reimbursement? Will be one of the things that we will try and analyze. Further, it says the word reimbursement means and implies restoration of an equivalent amount for something paid or expended. It presupposes previous payment. It presupposes previous payment. That means someone has made a payment and you restore that payment. In contrast, if you see in salary cases, we have a concept of allowance, where an allowance is given on monthly basis that may be spent or may not be spent. So that is why even in salary, one will have different taxation issues that will arise. For allowance, we have a fixed basis which is given in 1014, read with Rule 2BB, that how it will be treated. Certain allowances are exempt up to certain amount. Anything beyond that is taxable. But when it comes to reimbursement, 1014(1) read with Rule 2BB, it will provide that only to the extent it is spent is exempt. Any excess portion will become salary in the hands of the employee. So reimbursement terminology itself would mean that someone has to spend it first and the party will reimburse it, which is something which is given in advance will always be treated as an allowance and not as a reimbursement. And reimbursement is restoration of equivalent amount, actual amount which has been spent. It's an act of paying back somebody for his or her out-of-pocket expenses. So this is the concept of or general understanding of the term reimbursement. And as I said, there could be different types of reimbursement. Just to take this meaning further, if we have to say what are special features or prerequisites under what circumstances you will call a particular payment or receipt as a reimbursement, then these are 5 factors which I think can be treated or prerequisites for treating a payment as a reimbursement. The actual liability to pay should be of the person who reimburses the money to the original payer. As per the terms of contract, whose liability it was? Was it the liability of the person who spent the amount? Was it the liability of person who is claiming it? So whose liability it was, and that naturally needs to be determined based on the terms of the contract. Why this is important is, in multinational scenario and even in local domestic scenario, we will see group companies rendering services at cost. And we have many reported decisions, especially in the context of 195, that whether services rendered at cost, can you say it is a reimbursement? Now, will it satisfy this test? The actual liability to pay should be of a person who reimburses the money to the original payer. That is something which we need to see. As we go further, we will take certain examples and try to understand it. The liability ought to be having clearly determined. It should not be an approximate or varying amount. Because if we go by the concept of reimbursement, it says that first you should incur and then someone will reimburse it. And if someone incurs, then the amount is clearly determined. There is no question of any estimation or approximation. So the liability should be clearly determined. The liability ought to be crystallized. we have concept of future liability, contingent liability. Those aspects cannot be brought into reimbursement. You cannot say that I will reimburse you something which you may or may not incur after 3 months. That cannot be a reimbursement. For a reimbursement to happen, it will have to be an actual expense, and for which the liability is determined and which is crystallized. You really know that this is the amount I've spent and for this purpose, and this is how it has happened. It cannot be on a basis of some contingent liability which someone will incur in future. The payment should be first be made by somebody else whose liability it never was. So the person who makes the first payment, it was never his liability. He incurred on behalf of someone, and therefore he recoups that, and the repayment will square off that account. And there will be 3 parties in this transaction, minimum 3. It could be 4 in like cost sharing or cost contribution arrangements. It could be 3 or 4. So here there is one party which makes payment on behalf of another party for certain transaction. It could be travel, it could be hotel, it could be boarding, lodging, food expenses. It could be many various things in a business scenario. It could be statutory dues, as we see. So I may pay on behalf of my client and then take reimbursement from the client. So there are 3 parties in a reimbursement. Along with reimbursement, 2 more concepts that we need to understand is cost sharing and cost contribution. Cost sharing, as we all understand, is where there might be a common facility or common benefit or service which one party may want to take. Like for example, there might be a database subscription which I may want to take, but at the same time I may share it with someone. So 2 parties share and both of them try to pay 50-50 for that particular database. In such cases, one party may make the payment of 100 and try to recover the 50% from the other party. This is very common in market research kind of payments where there are group companies, say one in India and one in certain neighboring country, and then they want to undertake a market research for a particular launch of a new product. It is very common that the costs are shared. As we go further, we will see we have certain reported decision on this particular thing. One was the cricket sponsorship of World Cup. The sponsorship fees was shared between the group companies. Now, what should be the ratio of allocation between the group companies? The TPO disturbed the ratio of allocation and took a different view. So that is something could be a cost sharing concept. Cost contribution is also a very interesting concept used majorly in R&D, where suppose there are 10 or 20 companies in a group and all of them pool their resources to develop a particular product or a particular research or information related to research. And then the benefit of that research or information is shared between all the group companies. It's shared between all the group companies. So everyone contributes for that research. When you contribute for that research, what will be the characterization of this payment? Whether it can be treated as reimbursement, because many of these kind of situations, it will generally be on cost and there may not be a markup. We have certain interesting decisions on this particular concept also, especially in the context of international taxation, because whether you can term it as royalty and TDS should be deducted becomes an issue. So if we look at, I just try to break the reimbursement into 5 different categories. This is what I think could be 5 broad categories of reimbursement. No doubt there could be here and there unique cases of reimbursement one may come across, but what principles we discuss for these 5 broad categories, one can apply to those unique situations also. The first category is reimbursement of third-party expenses not having connection with any services rendered by the reimbursing party. What I mean by this is, in a group scenario, there could be one company in a group. suppose it is based in US and there are 10 entities across the world. So one entity may take Microsoft software license Office 365 for all the companies, and then the cost may get allocated to all the entities. And India may make a payment to its US parent entity. Now, when India makes a payment to US parent entity, it is not a regular business transaction between India and US. It is not connected with the services what India may be rendering to US, or there might be certain trading transactions between India and US. It is not directly connected with its regular international transactions or regular services or trading business. It is something unconnected to its business, which a parent company may only do for the convenience of the entire group, so that the expenses, one, there is a benefit of scale one could get. So you could buy, instead of buying 10 licenses, if you want to buy 1,000 licenses, it could make a difference in the pricing. Second, there will be some sort of a standardization that the parent may want. There will be some sort of quality control on what kind of equipments or softwares are being used. And at the same time, it will help the parent to control the costs. So this could be one type of reimbursement which gives issues both in income tax, transfer pricing, and the international taxation. Second is the OP that we generally understand. Along with services, I charge audit fees, plus I charge travel expenses or food expenses, conveyance expenses. I may do an ROC filing plus charge the MCA fees towards this. So these are the regular. So these are connected with the services. So when I render a service, this is an attachment or link or nexus with the services for these kind of reimbursements. Third is cost sharing, cost contribution, we just discussed. Fourth, again, this very unique. It comes up in multinational groups, larger companies, where services are rendered at cost. When you render services at cost, what are the implications? OTP, international taxation. Domestic may not be a major issue in those cases because the income concept does not arise in TDS deductions at least. There could be some accounting issues in such cases and certain other issues, but TDS issues at least will not arise in those kind of cases. So services rendered at cost. And these are live situations that we will come across, reported decisions on these aspects that we come across, which is there. It is not that it is something unique which doesn't happen. Salary reimbursement, again, a very burning issue in secondment arrangements, cross-border salary secondment issues, even local salary secondment issues happens to JV partners. The company may assign its employees to JV partners, salary reimbursement may happen there. So how do you do the TDS in those cases? So these are 5 broad categories I thought which could be relevant for discussion for all these 5 categories. Then what are the issues that arise? In international taxation, especially if it is a payment transaction, the issue is whether it will be liable for TDS. General understanding of ours is that if it is a reimbursement, it will not be liable for TDS under 195. Why that understanding has developed is the section 195 provides that the TDS will be applicable if the sum is chargeable to tax. If sum is not chargeable to tax, then the TDS under section 195 is not applicable. The Supreme Court has interpreted this word in GE's case, Geotechnology Center's case, and they interpreted these words to say sum chargeable to tax means that sum which the Indian party makes a payment to say your US company, that should be chargeable to tax in India. By virtue of sections 4, 5, read with section 9 and read with section 90, if the treaty is applicable in that particular case. So if it is not a sum chargeable to tax, then it is the TDS provisions under section 195 are not applicable. Now we will jump, everyone will then jump to a point saying that reimbursement, where is the income? If someone has incurred 100, I have made a payment of 100. Where is the income? Where is some chargeable to tax? There is no income arising. Why should I deduct TDS on reimbursement? In any reimbursement, this is the first argument we tend to take, saying that it is not liable for TDS. We'll analyze this aspect in detail for all the 5 categories of cases. Now, as we all know, TDS has its consequences. Your expense may get disallowed under 40A(1) of the Act if it is a payment to a non-resident. We have no doubt the attached consequences of 201(1)(a), where you will be treated as an assessee in default. But 40A(1)(a) is also a very burdensome issue, because the question will arise whether the expense gets disallowed and the taxation happens for that. The assessee no doubt pays not just the TDS, but also will be paying the tax on the enhanced income. As we know that in cases of domestic TDS disallowance, at least there is a protection, because if we are able to demonstrate that the other party, the recipient, has offered the income to tax and discharged the tax on that, and there is a certificate from CA available to that extent, the disallowance and assessee in default provisions may not attracted. Similar benefit has not been extended to non-resident payments. No doubt one can say that I will apply non-discrimination clause in the treaty and try to read those provisions for non-resident payments also. But the fact of the matter will be, in most of the cases, non-residents would not file their return of income in India. So there won't be any declaration that they've offered that income to tax, and the applicable income tax is discharged on that. So such kind of circumstances do not arise. So the disallowance under 40A becomes a major issue, especially in case of international payments. So this is one important issue that arises in the context of international taxation for reimbursement. Just to highlight it further, we will discuss no doubt when we go to each of the items of reimbursement, is when we talk of sum chargeable to tax, will it mean the gross sum or net sum? So that means if someone I have paid 100 and his cost of rendering service is also 100, can I say TDS is not applicable? This becomes relevant when we discuss the concept of services at cost. Can I say that it is not something which is applicable? It is not something which is applicable, because we have this gross basis of taxation for FTS and royalty, and net basis of taxation if the income can be classified as a business income and there is a permanent establishment. So this distinction, please keep this in mind, because in some cases this becomes a relevant consideration, and that you are to deduct TDS on gross amount. In some cases that situation may not be there, because it is treated as a business income and there may not be any P. So the conclusions will vary accordingly as we for different kind of reimbursements. Then when it comes to transfer pricing, very interesting issues arise. As I said in the beginning, for transfer pricing, both the reimbursement received and reimbursement paid are a relevant issue. You need to justify both. Both are subject matter of scrutiny under the transfer pricing. Both become an international transaction under section 92B, and both are, for both the situations, the transfer pricing is applicable. In fact, the Delhi High Court in Cushman Wakefield's case went a step further and said that the cost itself can be disputed if there is a related party transactions. So what the Delhi High Court said is, one needs to analyze whether cost itself is inflated. Cost itself is inflated. That was a case where certain payments were made towards reimbursement to a non-resident associated enterprise. That the argument of the assessee was that it is a reimbursement, it is at cost, so therefore it is at arm's length. And in fact, it's a favorable situation because my AE has not charged any markup on that reimbursement. I have paid, they have incurred 100, I paid 100. They have not charged me 102. If they charged me 102, then the issue was whether 2 is at arm's length or not would have been an issue. but they have paid only 100. The Delhi High Court made an observation that in a related party transaction, the cost itself can be inflated. First, you analyze whether 100 is correct or not, or should 100 have been charged, or only 80 should have been charged. So this could be a point of discussion and debate in the transfer pricing matters. And how to handle those kind of situations, we will see as we go forward. In case of reimbursements paid, as I said, if it is at cost and if the test of Cushman-Wakefield is satisfied, there may not be an issue. But if the associated enterprise has charged the markup, then the issue would arise whether the markup charged, whether is required. If required, then whether the markup is at arm's length, whether there should be any markup at all. In cases of reimbursement received, many times we come across situations where the transfer pricing officers take a view that why you have received only reimbursement, you should have got a markup on that also. You cannot just take the cost, you should have got a markup on that also. And that becomes an issue in the cases of reimbursement received. Also, while calculating the margins of comparables as well as the assessee, the treatment of reimbursement is an issue that needs to be addressed. CCA, if the test of 92.2, what it provides is that if there is any benefit or service or facility and you are making a contribution towards that benefit, service or facility, then the contribution to the benefit, service or facility should be at arm's length, So this is what the test of 92.2a is there, and that needs to be satisfied from the CCA perspective. When it comes to income tax, one is the tedious issue, whether under 194J, 194C, 194I, should I make tedious under these sections for payment of reimbursement, payment of cost sharing payments, then payment towards cost contribution arrangement, should a tedious be done? Whether disallowance will be attracted for if I don't do a tedious. That is one of the issues that we will discuss. Then in presumptive taxation, whether reimbursement should be part of the gross turnover or gross receipts, total turnover or gross receipts, is a relevant issue. If you see the terminology used, for example, under 44 AD, it says total turnover or gross receipts. So because the gross receipts word is used, the reimbursement received will become part of the base on which 6% or 8% should be applicable. That is the case with all presumptive taxation under the Income Tax Act. Salary issues we just discussed, that if it is an allowance, then naturally it is not reimbursement. But if it is a reimbursement, to the extent it is actually incurred, will be something which is exempt. The balance amount will become taxable. Now let's come to each of these issues and see how we can So the first issue, the first kind of reimbursement that we will try to discuss is reimbursement of third-party expenses. Now, these third-party expenses could be in the nature of, say, software, lease line charges, or some other expenses. So let's take an example where there is a parent company which incurs originally the expenditure, and then it is cross-charged to the group companies, and one of the group companies is an Indian company. Let's assume it is just a software license of Office 365. 1,000 licenses are taken at the US level. Out of that, 100 are shared to India. If the cost is, say, $10,000, $1,000 is cross-charged to India. The question will come, how do you characterize this payment, and how do you treat this transaction from a TDS perspective under the 195 international taxation provisions? Now, as we discussed, whether the 195 says the TDS will be applicable or any sum chargeable to tax. So whether this payment which I made to my group company, my US parent, is sum chargeable to tax. Now, sum chargeable to tax in the hands of US parent. So when the sum is chargeable, US parent's perspective, if you have to analyze the concept of sum chargeable to tax, the natural argument that all of us will take is that the US has incurred 10,000 rupees. Out of that, India share is 1,000 rupees and $1,000, and $1,000 are charged to India. Therefore, where is the question of there being a income in the hands of the US parent, and there should not be a Section 195 TDS, because the test of sum chargeable to tax is not satisfied. Whether this argument is correct, a couple of very interesting decisions. 3 decisions. First in the line was CU Inspections India Private Limited, which brought in the concept of look-through concept for TDS provisions. Now, here was a case where the training fees was incurred by the parent company in Denmark. The training was for Indian employees, exclusively for Indian employees, and the services were rendered from Denmark to the Indian employees. The service benefit was received by the Indian employees. The payment was initially made by the parent, and Indian companies, CU Inspection, reimbursed the training fees to the Denmark company. The reimbursement was on cost-to-cost basis. The assessee did not deduct TDS. The argument of the assessee naturally was that, look, this is a reimbursement. Denmark paid $100 for training. I reimbursed to Denmark $100. So the test of sum chargeable to tax is not satisfied. The tribunal said that, now if you look at this argument, before going to what tribunal held, if you look at this argument, this argument basically is, if this argument is accepted, then all the transactions in multinational group will be routed through their group companies, and one will claim that it is just a reimbursement, so TDS should not be done. That kind of a situation arises if this argument is accepted prima facie on the face of it. In fact, tribunal did not accept this argument in CU inspection, though you will find many cases where just on ad hoc basis, if it is a reimbursement without analyzing further, the relief has been given. But I would feel that that may not be a correct approach, because if that argument is taken, every transaction will be routed through US parent entity, and the question of TDS would not arise because it will always be a reimbursement. The tribunal said in CU inspection that you don't look at the Denmark entity or parent entity, look at the end party who is rendering the services. Now, this is a training services. The question that one needs to ask in such kind of circumstances is that if the end party, if in the hands of end party, let's assume training limited, and in the hands of training limited, if this payment is chargeable to tax or not, you apply the test of 195, sum chargeable to tax in India, to the end party, in our example training limited. And if that is so, then deduct TDS. You don't look at the parent entity in Denmark for determining the TDS applicability. Look at the end party, end service provider. So they brought in this look-through concept in the TDS provisions. So whenever this contention of reimbursement is coming, just be careful of these decisions, because the revenue will try to apply these decisions. And if the end party payment was in some way taxable in India, either has FTS or royalty, then you would have this difficulty in getting against these decisions, getting through these decisions, which to me have a sound logic. Though there are some flaws in this decision, I will discuss as we go further. But otherwise, the rationale is sound, because otherwise, if this rationale is not accepted, the assessors will try and route the transaction through their group companies and then say that it is a reimbursement, therefore TDS should not be deducted. In second case, Irshania Constructions Group India, the tribunal followed the same rationale of CA inspection and followed the same logic or same rationale. The third case also same rationale was followed, but following the same rationale, they said that income is not taxable. So here the parent company had taken a debtor collection services from one RMS, and the RMS charged the parent company, and parent company in turn charged the Indian entity. It was again on cost to cost, demonstrated with evidence that it is on cost to cost, which therefore was demonstrated. The tribunal applied the same rationale of CU inspection, said that even if we take the end entity, the services are debtor collection services, and debtor collection services will not fall within the meaning of royalty and FTS. Therefore, they are not taxable in India. Therefore, it is not taxable in India. And therefore, TDS provisions under section 195 are not applicable. So there was a sound basis to come to the conclusion that it is not taxable, but the look-through concept was still applied. Look-through concept was still applied. No doubt there are certain favorable decisions also. There's a Bombay High Court decision in WNS Global Services. Lease line charges paid by WNS Global Services and then reimbursement by the Indian entity to WNS Global Services held that it is reimbursement of expenses. They did not go into the aspect whether it is chargeable to tax in the hands of end party or not. They applied the rationale that it is a reimbursement of expenses and does not satisfy the test of some chargeable to tax, has no income arises to the recipient of the payment. Therefore, same is not liable for TDS. And they gave the benefit under section 195. In my personal opinion, I would tend to feel that CU inspection rationale and logic is sound. And if we go only by the concept of reimbursement, there is a potential chances that it would be misused in many cases. However, if I adopt the look-through concept, the issue would arise: how do you apply the treaty? How do you determine the rate of TDS? Whose TRC should be taken? Suppose I am reimbursing to my Denmark parent, but the services are ultimately provided by an US entity. The rate of TDS may be different. The TRC, whose TRC? Should I take the TRC of Denmark entity or end customer? What should be the rate of TDS? Under the Denmark treaty, there might be a different rate. Under the US treaty, there might be a different rate. So what are the answers to these questions? CU inspection does not offer. And these lead to a lot of practical difficulties, because when you file Form 15 CSCB, there will be a problem. You will say country of remittance Denmark, but if you want to apply a different treaty, there could be challenges in processing those 15 CSCB. Second, your ETDS return today do not visualize applying a rate under a different treaty when the remittances and the payee is of a different country. We are already facing these challenges in case of MFN clauses, most favored nation clauses. Though I may be rating the remittance to Netherlands, the rate might be borrowed from the Slovenia treaty of a lesser rate, which is happening today for dividends. The Netherlands treaties provide 10%, Slovenia treaty provides for 5%, but I can take the Slovenia treaty rate because of the MFN clause in the India-Netherlands treaty. If what happens, this will naturally throw open new issues and new litigations on these. Therefore, it is very important if the problems, but if they are in different countries, then this problem will arise, and one needs to address those issues in a fact situation that one would encounter. Even in the income tax context, we have a couple of decisions for these kind of payments where the reimbursement is of a third party expense. For example, in the case of Kodak India. Now, here was a case where payment was made to handling agents. So there were certain agents who used to do the handling activity, and payment was made to those handling agent. One was the handling fee. Then apart from that, crane hire charges, transportation expenses, and various other expenses. The TDS was deducted on only the handling fee. On other payments, the assessee took a view that this is a reimbursement of expense, and therefore I have not deducted the TDS. Kodak India has not deducted the TDS. The handling agents had raised the composite invoice on including both handling fee plus the reimbursement of expense. There was no separate invoice as such. The 201 assessment was done in the hands of Kodak India Private Limited. It was a 201 assessment, not a 48 disallowance. It was 201 assessment in the hands of Kodak India Private Limited. The assessee argued that these are only reimbursements. It is not the payment for crane hire or payment for transportation for 194C or 194H or 194I to apply. The fact also was that in this case that both of them had not deducted TDS. Kodak India also had not deducted TDS when it made payment of handling charges to the handling agent and along with the other reimbursements. And even the handling agent, when he made payment to the end service provider, even the handling agent had not deducted TDS. So this fact went against the assessee in this particular case. Given that both had not deducted TDS, the 201 order was upheld, and the tribunal took a view that the assessee should deduct TDS on the composite amount, on the total amount, and you can't take a plea of reimbursement. Contrast this with the next decision of Gujarat Narmada Valley Fertilizers. Here the agent had discharged the TDS, and given that the agent had discharged TDS, the High Court gave a favorable decision. This was a case of 48 disallowance. So 48 disallowance was made in the hands of Gujarat Narmada Valley Fertilizers on the ground that you have not deducted TDS on the reimbursements. The Gujarat Narmada Valley Fertilizer was able to demonstrate that it made payment to an agent, and that agent, when he made payment to the end customer, he had deducted TDS on those payments. So at least there is one level of compliance which has happened. Applying this rationale, the High Court took a view that as long as agent has discharged the TDS, it is sufficient, and disallowance under 48(1)(a) should not be made in the hands of Gujarat Narmada. So, no doubt one would have to look at facts of each of the cases. But if this kind of a situation is there, where you make a payment to some agent, which includes a composite fee of certain expenses, at least if there is one level of compliance that agent has deducted TDS, if that has also not happened, it is better that the payer deducts TDS when he makes a payment to agent. Otherwise, there could be situations where the disallowance as well as 201 order would be attracted in these kind of cases. Coming to the transfer pricing issue of such expenses. If these are payments, then you will have to necessarily demonstrate that, suppose we can go back to our example of Office 365 software licenses. If I make a payment for say $1,000 for 100 licenses which I have to use in India, naturally I will have to demonstrate that these were the licenses which were used in India, were for the benefit of the Indian company, and this is the payment I have made. Along with that, one needs to demonstrate that the end party payment was $10,000, 10% was for the benefit of India, 10% licenses were used in India, and this is the basis of allocation, number of licenses, and this is the amount which has been charged to India. The end party invoice, allocation basis, and rationale for use in India, this will have to be demonstrated from the transfer. These documents should be available with the associate as and when we certify Form 3C, we prepare the transfer pricing reports. This is a very important documentation which should be taken care. Generally, in cases of reimbursement, back-to-back invoices becomes challenge. Most of the clients do not maintain that or do not provide that. But as a good practice, is if you treat a particular transaction as a reimbursement, it is very, very important that this back-to-back documentation is available with the assessee. Otherwise, it could result in additions during the course of assessment. There are cases, as we go further, we will discuss certain cases where these type of situations do arise and additions happen. Any other aspect which arises in case of reimbursement paid or received. In the Indian cases where you receive reimbursement, where you have incurred an expenses, you receive reimbursement, and the impact on the PLI computation. Now, while calculating the margins of the assessee, if you get reimbursement, now that reimbursement could be a case where, like for example, one of the cases, Sony's case, where it incurred advertisement for in India. There was an advertising campaign in India and expenses towards advertisement was incurred in India. And portion of that advertisement expense was reimbursed by the group company, parent company to the Indian company. So I incurred 100 rupees and as a subsidy, 50 rupees was reimbursed to the Indian company. The officer, while calculating the margin, took 100 as the cost, but what 50 was received did not take it as income. Therefore, profit gets reduced to the extent of income and the margin goes down. And the margin goes down, it may not fall in the range. So when you receive the reimbursements, you have to be careful that to take it as a part of operating income for PLI computation in transfer pricing situations. It could be again a reimbursement from related party or from unrelated party, but if it is to the credit of P&L account, because the expense related to that reimbursement are part of your operating cost, the reimbursement received should also be taken as a part of the operating revenue to ensure that both are there. This is what was held in Bangalore Tribunal in Lineage's case, where they said that if income expense is part of the cost, then income should be taken. Naturally, it is a very logical thing, but as we know, in India, we go for these kind of issues also to the courts because the lower level officers do not appreciate these aspects. So the tribunal held that if you take expense as a part of the cost, then income will also have to be taken as a part of revenue. If for some reason the income is not taken, then the related expense will have to be excluded from the expense, from the operating cost. So this is an issue which may arise in the context of transfer pricing in these cases, in the case of these two. In the case of reimbursement of OP, as we discussed, these are cases where the expenses are connected with the services. Expenses are connected with the services. Therefore, what would happen is, I'm rendering a professional services. Along with professional services of say 10,000 rupees, I will add another 500 or 1,000 rupees towards conveyance, travel, food, hotel accommodation, etc. So here are expenses which have nexus, link with the services. They have a nexus or link with the services. The invoice might be composite, that with a separate line item saying that there is a reimbursement towards so and so expenses. There could be situations where invoices are different, they're separate invoices. In certain cases, reimbursement could be a very large component also. For example, if someone comes for training for 2 days, then the travel expense also will be substantial, and the professional fees no doubt will be there, but travel expenses could be a substantial component of the professional fees. How do you treat that kind of travel expenses, this kind of OPEs, which have direct link with the services rendered? Now, can you say that there is no taxable income, it is a reimbursement in the hands of recipient, it is not satisfying the test of some chargeable to tax in the context of 195, therefore there is no question of TDS being applicable on these additional payment toward expenses? Or will you say that the payment is linked to the services and therefore it retains the same character of the services? From the payer's perspective, it is still a payment for services. So if someone has come for training, you might pay him 10,000 rupees as the training fees plus 3,000 rupees as reimbursement. But from the payer's perspective, it is 13,000 towards the training fees. If you see the decisions in the case of Cochin refineries, where this kind of a situation arose, where certain technical services were taken from non-residents, and the technical services which were taken from non-residents had a component of reimbursement of expenses. The SSC did not detect TDS on the component of reimbursements on the ground that the test of sum chargeable to tax is not satisfied, and therefore it is not liable for TDS. The Kerala High Court took a view that in such cases, they are for rendering services. The reimbursement are also accessible as FTS, and they have to be understood as such. So you will have to detect the TDS on gross basis, including the reimbursement of expenses. You cannot segregate the reimbursement separately to take a view that same is not liable for TDS. And the test of section 195, sum chargeable to tax, is not satisfied. So Kerala High Court very categorically stated that such OPs are part and parcel of FTS, and they have to be treated as such. Same conclusion in Ashok Leyland and Nippon India, the Chennai Tribunal's decision. The Chennai Tribunal said that when there is a clear, it will be taxable in same manner. We can extend the same logic, whether it is royalty or anything else, that whether there is a nexus and link with the payment on the gross amount, including the reimbursement, the TDS will have to be done, and it will have to be understood as such. There is one favorable decision, though not a very comfortable decision. Siemens case, Bombay High Court, 310 ITR 320. Very interesting statement that the reimbursement cannot be regarded as income. For coming to this statement, it relied on the decision of Industrial Engineering, 202 ITR 1014 Delhi High Court. And the Industrial Engineering was a decision in the context of entertainment expenditure disallowance under section 37. An industrial engineering decision took a view that reimbursement is not a revenue receipt. The Bombay High Court in Siemens relied on that observation of industrial engineering to come to a conclusion that reimbursement is not an income. It cannot be regarded as an income. In my personal opinion, that would not be a proper approach in such cases where there are services and there is a nexus. When you have the terms of contract with the service provider, you will always say that for the service, I'm going to pay the professional fees plus the expenses, plus the out-of-pocket expenses. So it is a composite payment for the fee or for the rendering of services. The payment, the character is for the rendering of services. Therefore, it should be classified as FTS. One could take a legalist argument based on the language, because the words used either under 194J or from 19917 is fees for technical services, fees for professional services. Now, one could argue that reimbursement is not fees. Fees is the basic professional fees what I pay. This is a payment towards expenses. This could be one leg of argument that one could take in cases on need basis, where as a defense, someone wants to argue it in the course of assessment if you've already not done a reimbursement. But otherwise, the 3 to 4 decisions which I've cited are against. They have said it will retain the same character and based on the nexus. What is that you are paid for? You are paid for a service. And that service, the terms of service would say that you will make a payment of professional fees. Along with that, you will make a payment of out-of-pocket expenses. Same rationale should also apply for 194J kind of a situation. And one will have a similar issue there also, because it uses the word fees for professional services, but it would be more appropriate that in such cases the TDS is deducted. Further, in cases where like you charge an ad hoc amount for reimbursements, 10,000 rupees as professional fees, 200 rupees as reimbursement. Now that 200 rupees may not be there may not be evidence of actual expenses. Like we would charge for clients on ad hoc basis. Sometimes we know that there are 5 visits, but you don't have the exact amount of what could be the expenditure incurred. You don't know because you're traveling in your own car. On an ad hoc basis per trip, you would have charged as an OPE. So those cases, again, you can't take a contention that it's a reimbursement. It is a reimbursement. That contention would be very difficult to take because there's no matching. There is no one-to-one matching in those cases. And it is an ad hoc amount which is charged, which naturally will come with some income component in it. And therefore, the tedious provisions will get attracted for that. When it comes to transfer pricing, certain interesting issues arise in these OP. It looks very simple that it is just a out-of-pocket expenses and what issues should arise. But if you see the litigation around it, you will see what different kind of issues may arise for these cases. No doubt I've cited some cases which are different in context also, but it gives a complete perspective for these issues. Now, if you are paying OP, naturally the documentation and agreement should support that. That would be only the relevant issue from the transfer pricing perspective when you make a payment for the things. But when you receive OP, there has been considerable dispute in such cases. The transfer pricing officer generally would take a view that when you receive the reimbursement, you should have charged a markup on the reimbursement. They will take an argument that it is not a pure reimbursement. It is something that services are embedded in it. It is something for which the assessee has made certain efforts, and therefore assessee should get a return for those efforts. The assessee has blocked its working capital by incurring the expenditure first, and then it is a sort of credit given to related party and the amount is recovered after some duration. Therefore, the markup should be charged on such cases. For example, if you see captive units in Bangalore, software units, ITS units, which render services to their parent in US. Now the employees may travel to US and the travel and related expenses are generally reimbursed at cost to the Indian captive. One of the issues in the case of, for example, cited the decision LG Soft arose was whether this reimbursement received, whether you should receive without cost or it should be part of the cost. For these captives, many of them will operate on cost plus model. So my normal cost is say 1 lakh rupees, and I've incurred another 1,000 rupees as part of reimbursement, which I've taken directly as a reimbursement. And reimbursement will knocked off in the balance sheet. You will not bring it to profit and loss account. In lakh rupees is the cost in the P&L account. On 1 lakh rupees, suppose 20% markup is charged. 1 lakh rupees, 1,20,000 is invoiced to the parent company. Now the tax officer takes a view that the TPO takes a view that the 1,000 rupees which you have not brought in the P&L, which you kept in the balance sheet, 1,000 rupees of expense and 1,000 rupees of income, because you received the reimbursements, they are not passed through the P&L account. Either they've been kept in the balance sheet, there is a separate ledger for reimbursement and it doesn't come as a part of P&L account, or the traveling expenses gets reduced to the extent of reimbursement receipt. Whatever accounting methodology one follows, the end effect is same. The cost remains at 1 lakh rupees. The tax officer generally takes a view that reimbursement, you should have taken the cost as 1,01,000 rupees, not 1 lakh rupees. 1,000 which you got as a reimbursement. On that also 20% markup should have been charged. Now the issue is whether this 1,000 rupees should become part of operating cost. The tribunal took a view that this should not be included as a part of operating cost, and very appropriately so, because the expenses which are incurred are for travel and other things. And naturally, the way the industry functions, these expenses are even in third-party scenarios. These expenses will be reimbursed by third parties whenever you render these services to third parties. And even such third parties will reimburse this expense on cost basis and without a markup. So applying that rationale, one would say that these costs should not be part of operating cost. In the case of child communication, the tribunal was dealing with a slightly different issue. There, it was incurring certain media expenses. It was in the business of media ads, etc. And it was incurring certain media expenses for which reimbursement was being received from the clients. It had its domestic clients also. It was incurring certain expenses on their behalf. Those expenses, the assessee excluded both from operating cost and revenue. Expenses, media expenses incurred and media expenses reimbursement received. Both these were excluded from the operating cost and operating revenue by the taxpayer. The TPO took a view that the markup should be applied even on those costs. The markup should be applied even on those costs. The tribunal held in favor of the assessee, saying that these costs are incurred as agent and they are not the cost of the assessee. They are not meant for, they are not actually the assessee's cost. They are incurred as an agent, should be excluded from the operating cost and operating revenue. So these two decisions, you will see that the operating cost was excluded from the cost base. But that is not so when it comes to the three decisions in the last bullet: Kirbe Buildings, Television 18, Seagram Manufacturing. Kirbe Building is an interesting decision. The assessee, and this is also something which I could discuss, one would discuss under the head services at cost, reimbursement for services at cost. So I'm discussing it here, but it is relevant for that kind of reimbursement also. The assessee had an IT data center which were used by the group companies in India. It also did certain SAP implementation work for which it made payment to SAP India and certain other entities. First, it made payment, and based on man-hour basis, it cross-charged to the group companies, both for manpower ratio. It cross-charged both the IT data center cost and the SAP cost to the group companies. So the question was, can you charge it at cost? Is it a service or is it a reimbursement? Is it a service or is it a reimbursement? The assessee argued that it is a sort of an OP and it should not be part of the operating cost because I'm doing other services to the group company, and this reimbursement receipts are having a nexus in connection with this, and therefore it should not be treated as a part of the operating cost, and there should not be any markup on this. The TPO said this is a pure service, it is not an OPE, and therefore you cannot charge it at cost for both the SAP implementation as well as the IT data center services. The tribunal accepted the view of the TPO, saying that it is not a pure reimbursement kind of case, it is a service. You cannot disguise a service as reimbursement, and therefore markup is required. The TPO charged a higher markup. The tribunal reduced it to 5% on ad hoc basis, but that's a different issue. But the conclusion is that the services cannot be disguised as reimbursement. If there is a situation that there is an element of services, it is not a pure OPE or pure reimbursement. In those cases, from a transfer pricing perspective, the assessee will have to ensure that the markup is charged for such services. Otherwise, they run a risk of a transfer pricing adjustment during the course of a TP assessment. There's one more favorable decision of CPA Global, where there was an agreement that the Indian company will maintain a spare capacity, bench capacity, spare capacity of infrastructure, and that would be reimbursed at cost, and no markup will be charged on it. The department naturally took a view that there should be markup on this, but the tribunal and High Court upheld the contention that it can be reimbursed at cost. So this is not a pure OP kind of a situation, but just to highlight that it is case where the reimbursement were accepted, reimbursement received at cost were accepted as at arm's length. The facts are not very clear from this, that why spare capacity was maintained, under what circumstances, what duration the spare capacity was mentioned. No independent party will maintain a spare capacity for very long duration. If there is an anticipation of future enhanced work, one could maintain for a few months, but it not be for a very longer period. Those facts are not very clear from the tribunal and High Court decisions. Therefore, it is difficult to say whether it would be appropriate to take this view that spare capacity only cost reimbursement would be fine. One will have to go by facts of each case and take a particular view. But the decisions in Kirbe, decisions in Seagram, both the Seagram and Television 18 are cases where they did marketing activities for their foreign parents in India. As a part of marketing activities, certain media expenses were incurred. They took a view, Seagram and Television 18, that media expenses, the reimbursement should happen at cost. The tribunal did not accept this contention. They said that your reimbursement of media expenses is connected to main activity of marketing activity. The job of Seagram and TV18 itself was marketing services. When you are providing marketing services, then the media expenses having direct nexus with those services, and the markup should be charged even on that case also. Contrast this with the first case of child communication. There, the media expenses were received and paid with third parties. It was not a related party transaction, and assessee was not rendering marketing services to A. It was in the business of media, communication, advertisement, etc. Whereas in contrast, the Seagram and Television 18, they were rendering marketing services, and in the course of rendering marketing services to associated enterprise, they were rendering marketing services to associated enterprise, and in the course of rendering marketing services to associated enterprise, they incurred these expenses, and therefore tribunal took a view that even a markup should be charged on such cases. These decisions appear proper to me in the context in which they are, and therefore if the associates are trying to move the cost at reimbursement, but there is a service element in that, then we need to be careful. There could be transfer pricing adjustment which could be attracted. Next set of issues come from this cost contribution arrangement, cost sharing. What would be the treatment for cost contribution arrangement, cost sharing? We discussed in the beginning what do we mean by cost contribution arrangement and cost sharing. The OECD defines a CCA as a framework agreed among the enterprises to share the costs and risks of developing, producing, obtaining assets, services, and rights. Share the cost and risk of developing, producing, obtaining assets, services, and rights, and to determine the nature and extent of the interest of each participant in the results of activity of developing, producing, obtaining those assets, services, and rights. So here are parties which agree to share the cost and risks of developing a particular service or right or asset, and they want an interest in that service or right or asset to ultimately get some benefit out of that service, right or asset. These are very common features of a CCA in the case of multinationals R&D activities, where an entity across different geographies, different countries will contribute to the R&D, and the benefit will be shared to that. It could be R&D. Nowadays, IT infrastructure costs are generally shared by group companies. You may have common data centers located somewhere in the world, and those costs may be shared. So there is something like cost contribution which happens in case of R&D. Cost sharing happens in case of IT data networks. There could be common management service organizations within the group which could incur the expenses, and then it could be shared between different parties. So the issues, again, all these issues in terms of international taxation, transfer pricing arise for these cases. How do you handle these kind of cases? Whether can you say it's a reimbursement, simple reimbursement and forget it? Possibly no. These are different genre of reimbursements, different category of reimbursement, which requires a proper treatment, both from transfer pricing and international taxation purposes. Even in domestic taxation, this could be an issue in certain cases, though we do not see these kind of cases much in domestic taxation, at least not the CCA. Cost sharing, yes, we do see between group companies where cost sharing happens and tedious issues arise because of cost sharing. I have a list of decisions which I will cite at the end of the presentation, which I've shared at the end of the presentation, where they've said cost sharing, at least the disallowance under 40A should not happen. Rent premises shared. There's no requirement of deducting TDS. Those things there. Cost contributions are more unique in international scenarios, and they lead to unique transfer pricing and international taxation situations. The decision of AP Molar 392 ITR 186 of the Supreme Court was on the IT costs. Here was a situation where it was more of a cost sharing, not cost contribution. It was more of a cost sharing, that the AP Molar had developed an IT system. It was into the shipping business, and the data movement related to the shipping, transportation, freight charges, etc., was captured in this IT system. The IT systems were shared to agents in India, and these agents were third-party agents, 4 to 5 agents in India who shared this IT cost, and the IT cost was recouped from the agents. So agent made the payment to these AP Molar. In the hands of AP Molar, there were two categories of income. One, the shipping income, which was claimed as exempt under Article 9 of India-Denmark Treaty, and there was this reimbursement, recoupment of IT costs. The shipping income was accepted to be not taxable by the tax authorities, but when it came to recoupment of IT costs, they took a view that it is fees for technical services, and it is not something which is a reimbursement, and it is not something which can be accepted to be not taxable. They said that it is fees for technical services, and therefore it is taxable in India. Now, here is a case where agents have made a payment, and the cost has been recouped at cost without any markup. What would be the characterization of this payment, and whether it can be treated as reimbursement? The observations of Supreme Court on reimbursement are very interesting, and that can be used maybe in other cases also. The Supreme Court says once the character of a payment is found to be in the nature of reimbursement of expenses, when the character of the payment is found to be in the nature of reimbursement of expenses, it cannot be categorized as income chargeable to tax. So if it is reimbursement, it cannot be categorized as income chargeable to tax. So in a way, Supreme Court's decision says reimbursement is not income chargeable to tax. We have discussed certain other aspects during this presentation where I've said that we can't take this view. But if you take this particular Supreme Court decision, there's a broad sweeping statement of Supreme Court saying that reimbursement is not income chargeable to tax, and therefore applying this 195 would not be applicable. However, as I have discussed in various slides, and also we will discuss as we go further, this may not be as easy a statement as it appears that every reimbursement is not taxable. There could be circumstances and needs to see the facts and come to a conclusion. No doubt, the observations of Supreme Court one may try and use in litigation. If you are stuck in litigation at CA appeals or tribunal or high court, it could be something which one could use it. Also, in this particular case, the question was whether the recoupment of IT cost is an FTS. The Supreme Court took a view that it is not fees for technical services. So no technical services are rendered by AP Mola to the agents. It is not running any managerial consultancy or technical services. It is just giving an IT system which provides information about the transportation, flight charges, etc. Therefore, it is not fees for technical services. The Supreme Court also concluded that the recoupment of IT cost is integrally connected to the shipping business. It has nexus with the shipping business. Therefore, it is shipping income, and Article 9 exemption will be available to the AP Mola and the income will not be taxable. However, as I said, the observations of Supreme Court and reimbursements are interesting. One could look at that. But more relevant decision would be the ABB's decision. In a very interesting decision, a worth reading decision, the way the transaction has been structured and way the arguments have been made and way the decision has come out. Now, here ABB has a policy of group R&D, which was done in Zurich, Switzerland. So the Switzerland entity was handling and coordinating the R&D at the group level. ABB India wanted to participate into this R&D. It wanted to contribute to this R&D, and there was a proposal to enter into cost contribution arrangement. So as per this, what happens is anyone who participates in the R&D activity, any company that participates in R&D activity will get the benefit of R&D. The entire research will be made available to the participant. So if ABB Limited participates, the benefit of that research, all information, etc., will be made available to the ABB India. Now, once it is made available, the ABB India can use that research for its business activity. It does not have to pay any royalty. It's a royalty-free information which is made available to the Indian party, ABB India, which it can use for the business purpose. This is a very important point, that it gets the information royalty-free. In contrast, when we discuss the next decision, CGI information, if you see the facts, how variation in the facts led to a different conclusion. Now, in ABB India, because this was a cost contribution, the issue was whether I'm contributing to this cost, whether this will be treated as reimbursement and not taxable, or will it be classified as FTS or royalty. The department naturally argued that it should be classified as an FTS or royalty. The argument that SSC made was, look, there is no transfer of any patent or etc. to classify it as royalty. And the group is not rendering any services to me. I am contributing to the research, and the research will be made available to me. It will be made available to all the participants. The entity in Switzerland can also subcontract research to certain research centers within the group, where it will pay cost plus to those research centers, and the research ownership of IP will be with the Switzerland. Also, the legal ownership was with the Switzerland entity, legal ownership of the IP, that was for administrative convenience. That was only for administrative convenience, and it was not for other things, because India was getting a right of economic ownership of IP, and India could take a need not pay any royalty. It was a royalty-free information which was available. So these were the facts, and the AR took a view that, look, what are you contributing for? is there any transfer of any right, etc.? It is not happening because it is your own. The assessee is contributing for developing its own products, for its own research, its own R&D. It is not taking the R&D or patents, etc., know-how, technical know-how, etc., from the Swiss entity, but it is contributing to create an ownership in that. So it is not in royalty. There is no services rendered, so it cannot be FTS. It can only be classified as a business income, and therefore, in the absence of P of the Swiss entity, there is no liability to tax in India, no TDS needs to be done. No doubt the end conclusion did not come on reimbursement, but but it is something for us to appreciate the way transaction is there, the way it has been analyzed, and in cost contribution arrangement, this kind of a situation could emanate, and one have to take a view based on what the ER has said. Similar conclusion is in case of Dunlop Rubber, where the R&D facility was in UK and the payments were made for the R&D. The payments were made for the R&D, and that payment was held to be reimbursement. So Dunlop went on the basis that it is reimbursement, and therefore 195 is not attracted. No income arises because it's a reimbursement. The ABB went on the concept that it is not FTS royalty, it can be classified as business income, but the ABB Swiss has no P in India, therefore it is not taxable. Though they have taken different directions for the end result is no doubt saying that it is not taxable in India. Dunlop's Rubber's case is directly saying that once it's a reimbursement of cost, it is not taxable in India. It is not taxable in India. Contrast this with the Karnataka High Court's decision in CGI. And in fact, the High Court makes certain remarks saying that cost sharing is just a device to avoid tax in the case of CGI. But in case of CGI, the parent in US had developed a particular telecommunication tool. It was first developed. The legal ownership rested with the parent. In contrast, in ABB, the Indian entity got a royalty-free right to exploit the research. Whereas in case of CGI, there was no such right available. As per the terms of agreement, the tool was developed by the parent, and it was used by the group companies. Based on number of employees, the cost of development was charged to the companies. As per the agreement, India got a right to use the tool, no other rights. It only got a right to use the tool. The assessee argued that it is a cost to cost and it is a cost sharing arrangement. Therefore, TDS under 195 should not be applicable. The High Court took a view that cost sharing is just a device to avoid tax. India is not getting any rights, and therefore we don't take it as you are only getting a right to use. And in the time when the CJ's decision had come, at that point of time, the Karnataka High Court's decision in Samsung and Synopsys held the field, saying that software license is royalty. Those two decisions, Samsung and Synopsys, held the field that software license is royalty. Applying those decisions said that this telecommunication tool results in TDS, it is a royalty and TDS should be deducted. No doubt situation has changed today. The Supreme Court's decision in engineering analysis has taken a view that software is not royalty and there is no liability to deduct TDS. So therefore, maybe that principle can be extended to CGI's case. But the point here is, in this case, the tool was developed first, then the right to use was given. So it was not treated as reimbursement. What I want to really highlight is that it was not treated as reimbursement or cost sharing. It was taken as royalty. No doubt it may not be royalty today, but can it be something else? Can it be FTS or something else? So those are aspects that this decision highlights in contrast with Dunlop Rubber or ELR, where a different view has been taken. This case, different view has been taken. So we will have to be very careful in these kind of a situation. How do we structure the transaction? How do we define the terms in agreement? Only on that basis someone can come to conclusion that whether the income it can classified as a reimbursement, can classify as a cost sharing, or it will get classified as a service or royalty liable for TDS in certain cases. In the domestic context also, there are some cases. I'll discuss those as we go forward. But the CCA results in TP issues, and as I highlighted in the beginning, 92.2 says that service benefit or facility, the ELP should be determined, what contribution you made should be on the arm's length principle. They're not direct decisions, and this issue is not come across in the Indian context, but the point is, when you make a contribution for these kind of facilities, what is the benefit that one gets? What is the contribution one makes? That has to be, the cost benefit analysis has to be done from the TP perspective, and you need to see what are the allocation key in which basis the cost of the R&D facility or any other facility has been allocated to India. So if it is an IT facility and it is allocated, say, based on number of employees, then it could be one of the fair ways of allocating those costs. So that allocation basis should be available from a transfer pricing perspective. What is the total cost incurred for the facility? How it has been allocated to Indian company? That documentation needs to be maintained from a transfer pricing perspective. These two decisions I want to highlight for cost sharing and cost contribution. The second one is interesting one, LG Electronics Care. There's a payment was made for Cricket World Cup sponsorship. The payment was shared between the Korean entity and Indian entity in the ratio of 60:40. Indian entity bear the expense of 40%. The TPS said that cricket is not the only game that we play in India. There's no necessity of you incurring so much of expenses on cricket sponsorship. There are other games also, athletes are also there, etc. and etc. And the allocation basis is wrong. Second, the cricket is also played in other countries. The benefit of Cricket World Cup, because you have viewership across the world, so you cannot allocate 40% to India. You should allocate on the basis of global profits. And the profit of India in the global profit was 5.4%. So the allocation ratio was changed from 60:40 to 5.4% and balanced to Korea. The differential amount of 40% to 5.4% was disallowed, running into a couple of crores. This matter traveled to tribunal. The tribunal adopted the basis of sales. That sales in India out of cricket playing nations. Now they looked only at cricket playing nations. The argument of TPO was that the game is viewed in various countries where there may not be actually playing the cricket. There might be viewers. But the game might be played in the country may not be actually playing cricket, but it might be only viewing the games, and therefore the sponsorship could promote the LG products in those countries also. However, the tribunal went on the basis of sales, that the sales of India is 41.33% for out of the cricket playing nations. So only cricket playing nations were taken, not the entire world. Only cricket playing nations were taken, and based on that sales ratio, they said 40% is arm's length. So this is how the allocation ratio of 40% was justified and accepted as arm's length by the tribunal. The first decisions of Patni Computers, where certain consulting fees was paid to McKinsey for entire group restructuring and business restructuring and development of new business lines, etc. The AO said that why India should bear all the expenses. Your subsidiaries across the world also are getting benefited by the consultancy given by McKinsey. He assumed that the subsidiaries are also getting benefited. So 30% of the consultancy fees was allocated to the subsidiaries and disallowed in the hands of the Indian entity, made as a TP adjustment. The tribunal said that there is no evidence that subsidiary is benefited. There is no agreement for allocation of expenses. Therefore, we do not accept the contention. Here, the TPO made just an premise that the subsidiaries might have been benefited. Just that premise doesn't help. There has to be evidence, which was lacking in this case. Therefore, the additions were rejected. We come to fourth category, services rendered on cost. Whether when the services are rendered on cost, whether one can say that the whether it can be classified as reimbursement. And we do see these kind of live cases where the group renders services on cost and the payments are made demonstrably on cost, and the argument is taken that it is just a reimbursement. Time and again, tribunals and AIs have held that this is not acceptable. They've taken a view that these payments will be taxable, will be something which is taxable. Now, what happens here is, if you take Timken's case or Denfo's case, the Denfo's case was a market research, and then the cost of market research was shared between the group entities. So there was a Singapore entity which was doing market research, and that cost of that entity was shared among the group companies, that particular division of market research. Now, the 195 no doubt says some chargeable to tax. So if you look at from that perspective, 100 rupees is the payment made, 100 rupees might be the cost. In Denfo's case, the AR observed that we accept that the payment is at cost, but that doesn't mean that test of income is not satisfied. The Singapore entity incurs various expenses. Out of that, cost is allocated to India. There is no one-to-one correlationship. It is just an allocation. It is just an allocation. And that cannot be taken. For 195 purposes, they are saying profit margin is not a relevant criteria. Profit is not relevant for determining the taxability. Because if we say profit is relevant for determining 195's applicability, then in every case where the foreign company is making a loss, one would argue that there is no 195 applicable at all. The whole purpose of 195 would be lost. Second, the royalty for FTS and royalty, these are taxable on gross basis. You don't look at the expense today. These both items, interest also, dividend also, but more royalty and FTS because you have expenses, especially for FTS you will have expenses. So you are taxing that on gross basis today. The law provides for taxation on gross basis, both act and the treaty. And when the gross basis taxation is provided, can someone say that because I am not having any expense, the expense are equivalent to income and there is no profit because I'm not having any profit, therefore there is no liability to deduct TDS? That proposition may not be correct. That proposition may not be correct, because once the gross basis taxation is provided, the deduction of expenses is barred under that and under the tax treaty. Therefore, when I'm looking at taxable, when I'm looking at sum chargeable to tax, I need to look at whether on a gross basis there is a sum chargeable to tax. And once I apply that principle under section 195, there is a sum chargeable to tax. Though the services may be rendered at cost, the rendering of service at cost does not affect the character of service or does not affect the character of payment. In all these cases, rendering of services at cost will not be helpful and TDS needs to be done on gross amount. Just an argument that it is a reimbursement of cost incurred for rendering services may not be helpful. In my opinion, the correct view would be that these payments are liable for TDS. No doubt there is an instruction of 2 of 2014. One can rely on that, but only in cases you want to defend it, because that instruction said that if you pass a 201 order, in 195 context, it should only be on the proportion of income. You should determine, the AO should determine the proportion of income which is some chargeable to tax, and only on that income the taxability arises. One could rely on that. But if you look at the principles, that instruction is more relevant, where some payment may be taxable, some payment may not. There's a composite, and only a portion of income may be chargeable to tax in India, not the entire portion may be chargeable to tax in India. FTS, where the gross basis of taxation is applicable, in those cases, applying this instruction and applying the theory that there is an expense, therefore net it is zero, will not be correct in my opinion. It is also so held in this decision 10-4 in Kotekna inspection India, where they have said rendering of services cost is not a relevant criteria for determining 195 applicability. When it comes to TP, if services are received at cost, then no issues at all. If you are demonstrating that, then it is good thing. 92.3 will protect you. 92.3 says that you cannot apply TP to increase the loss in India or reduce the income in India. If services are received on cost and have not paid a markup, it is a favorable from Indian perspective. So 92.3 will be protected. But if you render services at cost, as we have seen the earlier decision of prepaid bargaining, those in all probability not acceptable unless you are able to demonstrate some bundled approach, saying that these services at cost are connected and having nexus with other services or other business activity, and therefore on a commercial basis, I have overall basis, I have made certain profits. That kind of an argument is there, then fine. If that kind of argument or bundled approach cannot be adopted, it will be difficult. Last aspect is reimbursement in the context of secondment. This is now a very largely litigated area, having high court decisions on both sides, and it has so much time has gone by where this litigation is immersed. Still, we don't have certainty on the matter, and it's a sort of a painful issue in many cases, because in a global situation, the Indian companies do require people from outside India for having expertise, and these people may be present in other group companies, and you want them be in India for a couple of years. Now, at the same time, there will be some overlap of employment, dual employment concept to do work, and those cases, the salary may be paid by group companies. Say if it is Japan, Japan may pay salary to the bank account of the employee outside Japan. Indian company may reimburse to Japan. Indian company will still remit 192 TDS by applying gross up of 195 capital A. And TDS on 192 would be done. But this reimbursement which is paid, whether is taxable as FTS, as the department has been consistently taken a view that this is FTS, and the association should deduct TDS on these reimbursement of salary. The argument is the real employer of the expat employees is the foreign company, not the Indian company. So crux of this issue for the secondment is who is the real employer. We have various Indian judicial precedents also, but it is very beautifully summarized by CA on his comment on Article 15 that how do you define who is the real employer? It says who has authority to instruct the employee and how the work should be performed. Who has that authority? Who controls and has responsibility for the place at which the work is performed? The remuneration of the individual is directly charged by the formal employer to the enterprise to which services are provided. Who puts the tools and materials necessary for the work at the individual's disposal? Who has the right to select the individual who will perform the work, to terminate the contractual arrangements entered into the individual who has the right to select or terminate the employment, who has the right to impose disciplinary sanctions, who determines holidays and work schedule. So one needs to apply this test. There are too many contrary decisions in favor of revenue, Delhi High Court, Madras High Court, in favor of SSC, Karnataka High Court, and the Marks and Spencer's Reliance Retail case. So the contrary decisions are there. Both sides' decisions are there.
Sir, voice is breaking, sir.
Voice is breaking.
Yeah, sir. Please disable the video, sir. Your bandwidth is very low.
Okay. Okay. I hope it's fine now. So, so there are quite few for and against decision. Now there is a special bench in Yokogawa's case constituted at Bangalore to look into these issues. So hopefully we get some certainty of this. But the crux of the issue is based on the terms of agreement, terms of contract, employment letter. Who is the real employer? That is what one needs to see in such cases. And based on that, the decision should be taken. We'll go to important aspect of documentation and disallowances. We're left with 15 minutes, so I'll try to cover these up. So documentation, what should be the documentation one maintains? Either we look at from international taxation perspective, domestic taxation perspective, or we look at from the perspective of transfer pricing. What are the documents one should maintain? One, agreement between parties, clearly stating out the terms of reimbursement, who will incur expenses, what will be the payment terms, how the payment will happen. Debit note for reimbursements, back-to-back third-party invoices matching with debit notes. This is very important. Back-to-back third-party invoices matching with debit notes and debit notes. Back-to-back invoices at many times are missing. This creates some problem in many cases, and it creates challenge both from international taxation perspective, whether TDS is to be done or not. It creates challenge from transfer pricing perspective. In a domestic scenario, this could still be easy because you will be able to get, may be able to get this data subsequently. But with international parties, getting this data after 3 to 4 years becomes very difficult situation. So try to get these details when the transaction is entered into, when you are making the payment and not subsequently. It should be part of SOP of all the parties. It should be maintained by all the parties. And we as auditors and people who are suggesting the clients should insist on these documents to be available when the transaction is being undertaken. If it is a cost allocation, which would arise because of cost sharing, which would arise because of CCA, in those cases, the backup of cost incurred, allocation key, actual allocation, wherever possible, the allocation should be supported by audit certificate. If that is available, it becomes really helpful to justify the allocation. Otherwise, challenges do arise. In many times when the details are missing, back-to-back invoices and allocation keys, the transfer pricing officer says that the arm's length price is nil and entire expense has been disallowed. No doubt courts have not accepted this, but one needs to go through a long route of litigation to get that judgment. If the documentation is proper, one could be able to satisfy this at the lower levels itself and get a favorable order. When it comes to secondment, the agreement for cost charge, assignment letter between foreign company and seconded employee, the employment letter between Indian company and the individual, debit notes for expenses, supporting for payment made to the employee towards salary. So these documents should be maintained. These documents should be maintained. Now, if you look at the disallowance under 40A1A, the various case laws have emerged. Various issues on cost sharing, reimbursement of expenses, how the courts have treated it. I've made certain classifications, and for certain expenses, I've tried to see what could be favorable decisions to the assessee. Now, these decisions are more from the point of view of from the point of view of disallowances, where favorable view has been taken. In cases of Dhanya Seeds Bangalore Tribunal, the payment was to C&F agent who incurred certain expenses on behalf of the assessee. And because it was a reimbursement, the tribunal took a view that TDS under section 194C is not applicable for making reimbursement, and therefore no disallowance should happen. Similar view was taken in case of consumer marketing's case by Gujarat High Court, and in that case, in fact, the C&F agent also has a separate bill, and on that separate bill for reimbursement of expenses, the High Court took a view that TDS is not applicable. High Court took a view that TDS is not applicable. Similar view has been taken in Swastik Pipes for 194C, that inland haulage charges paid to C&F agents will not be applicable. And in case of PP Overseas, reimbursement was of a statutory liability, certain statutory dues, and therefore there was no liability of TDS. Cost sharing, utility power tech limited. Here was a case where it was office upkeep, etc. That it is reimbursement of cost, is a cost sharing. Therefore, there is no obligation to do TDS. Therefore, disallowance into 41A should not happen. Similar is the case of Myco Mansonata, where the expense were reimbursed to group concerns, and the employee took a view that the AO took a view that the disallowance should be done. The tribunal held that it's a reimbursement of expenses, no disallowance under 41A. ITT Chem JV partners were there. Bombay High Court took a view that TDS disallowance should be rejected. Here, the JV partners' administrative expenses, office administrative expenses, was a matter of dispute. With respect to office administrative expenses was shared between the joint venture partners. Genuineness of transaction was not doubted, and therefore the disallowances was deleted by the Bombay High Court. Then we have salary reimbursement, couple of cases, and lease rent. Lease rent, where one party paid the rental and other party reimbursed it. The reimbursement was paid to S, and S had already deducted the TDS. So if you apply earlier discussion also of Gujarat High Court, we had discussed earlier. So because one party has at least deducted the TDS, they said disallowance will not come into picture. The first two cases are of salary reimbursement in the domestic context, where 194J was applied. The OCB engineers case, Bombay High Court, that if this TDS on salary reimbursement paid to sister concern is not there, first party has already deducted TDS as salary under 192 when it paid to the employee. Reimbursement paid is just a reimbursement. Therefore, 194J is not applicable. Therefore, 41A is not applicable. Similar view for Mahanagar Gas, that the reimbursement of seconded employee to A couldn't be treated as FTS under section 194J. So these are some decisions which I thought could be helpful, relevant in domestic context, and which I have highlighted. One could try to look at these decisions if the fact patterns are similar in the real life situation one basis. So with this, I have tried to cover the aspect of reimbursement on various different kinds of reimbursement issue arising from those. I hope the discussion is helpful and there is a value addition to all the participants. Again, thank and India and Bangalore branch for giving me this opportunity to present my views on this particular topic, as it is always when you try to present, in fact, the greater learning is for the persons preparing for the subject and who is presenting the topic. So I thank Bangalore branch for this. If there are any questions, surely we can take for next maybe 5-10 minutes. And I think this question has been
Yeah, no questions so far.
I think one question came in the chat box.
Sir, there is one question, sir.
Yeah, please.
Just now we received one question. If a parent company, suppose in Denmark, incurs professional fee for services provided in Denmark on behalf of India, and India reimburses to the parent company, whether in such case, look-through concept applies, as if India has directly paid through service provider in Denmark, even though professional service was consumed in Denmark by parent company. Whether TDS on such reimbursement is applicable to India under 195.
Sorry, Divya, I just lost it because because of some connection issues. Can you please repeat the question? Apologies.
I'll repeat the question.
Yeah.
If a parent company, suppose in Denmark, incurs professional fee for services provided in Denmark on behalf of India, and India reimburses to the parent company, whether in such case, look-through concept applies, as if India has directly paid to service provider in Denmark, even though professional service was consumed in Denmark by parent company. Whether TDS on such reimbursement is applicable to India under 195.
Now, if the services are meant for, if the services are meant for Indian company, then the issue of look-through will come into based on the decision of CU inspection. So the parent is in Denmark, the Indian company is in India, the service provider is in Denmark. Now, if the service provider has rendered the services for the benefit of India, in that case, the look-through concept as highlighted by the tribunal will be applicable. Yeah.
That's also no other question.
Okay. Yeah.
So one more question just now. In TP report, what should be the method of determining in respect of reimbursement payment? Able to hear, sir? Narendra, sir? Hello? Narendra, sir? Narendra, sir, you're there?
Hello.
I think some signal
Yeah.
problem. Narendra, sir is not online.
Yeah, anyhow.
Sir, I'm calling.
Hello.
So shall I read out the question, sir? Narendra, sir?
Yeah.
Yeah, please.
Yes, I'll read the question. There's one question. In TP report, what should be the method of determining in respect of reimbursement payment?
Now, in case of method which we should put for these kind of reimbursement, assuming the cost to cost basis we are able to justify, in those cases you can select the other method, sixth method, rule 10AB, because all other first 5 methods, 4 are margin based method, RPM, CPM, TNNM, PSM. So naturally margin doesn't arise in a reimbursement context. So that we cannot take as a method. Either the choice then narrows down to CUP method or the sixth method, Rule 10AB method. Now, CUP depends on comparable, which is not there here in these cases. So in those cases, the sixth method would be most suitable method, which should be selected.
Sir, only those many questions, sir.
Okay.
Sir, can we wind up?
Yeah, we'll wind up.
Okay.
Yeah, we had a
members?
fantastic detailed session from Narendra sir, and it's a very, very interesting reimbursements, all the issues he has dealt in. So thank you very much on behalf of Bangalore branch. Friends, you are the reason for this program. So we have arranged 3 days transfer pricing workshop starting from tomorrow. I request all of you to register that program. So over to Divya to conclude officially.
Thank you, sir. Dear members, I take this occurrence on the Bangalore branch to the formal vote of thanks for today's program. Wholehearted thanks and giving an excellent presentation. Thank you so much, sir, on behalf of all the participants and also on behalf of the entire management committee. Thank you, sir. Thank you all the participants for active participation. Request you all to kindly look into Bangalore branch website for further programs coming tomorrow. Thank you all. Thank you, Chairman, sir.